Every master, every successful speculator, loses money on trades approximately 40% of the time. This is not a failure of strategy. It is a mathematical certainty of the business. You must accept that losing is part of the cost of doing business, just like rent or electricity. 99% of all who attempt this profession will fail, and they fail for one simple reason. They mistake a run of favorable luck for genuine, repeatable skill. They confuse aggressive, reckless wagering with calculated risk management. Fear of loss is not the problem. It is the inability to quantify the loss before the trade begins that leads to ruin. I call the principle of survival the prime directive. On any single trade, at any time, under any condition, you must never risk more than 1% of your total trading capital. Your account size is the fixed capital of your enterprise. 1% is the fixed cost of testing an idea. Violate this rule once, and you open the door to emotional ruin. Understand the law of irrecoverable loss, which the crowd never bothers to calculate. When you lose 10% of your capital, you need to gain 11% just to break even again. A 25% loss requires a 33% gain. The recovery percentage always far exceeds the loss percentage. The crowd seeks the quick score, the 10-bagger, the sudden change in their financial standing. But the Hook Law states that small, precisely calculated risk is the only sustainable path to wealth. Sustainable growth is boring, methodical, and slow. Overnight riches exist only in the stories the brokers tell to lure the reckless. The definition of risk must be perfectly clear to you. Risk is not the stop-loss asterisk price asterisk on the chart, but the specific fixed asterisk dollar amount asterisk you are prepared to lose. This dollar amount is precisely 1% of your working capital. The distance to the stop-loss price dictates your position size. The 1% rule dictates the maximum size of your potential mistake. Listen carefully to the law of drawdown mathematics. A devastating 50% loss in capital requires you to find a full 100% gain just to climb back to where you started. That is the chasm created by greed and irresponsibility. The 1% rule is the firewall that prevents this catastrophic loss spiral from ever beginning. When your loss on any single trade is only 1%, you must lose 100 consecutive times just to wipe out the account. The compounding law is the quiet secret of true wealth creation. Small, consistent profits, even if they only amount to 2% per week, will mathematically outperform large, sporadic wins that are followed by massive, reckless losses. The reckless trader finds a grand success and immediately risks it all in a subsequent poorly planned venture. The professional seeks consistency, and that consistency is only built on the foundation of capital preservation. The law of absolute position sizing is non-negotiable for the master speculator. Your position size is not determined by your gut feeling or the price of the stock. It is a mathematical calculation based solely on the distance between your entry price and your predetermined iron-clad stop-loss price. The size of the risk, 1%, divided by the distance to the stop, in dollars, gives you the maximum number of shares or contracts to purchase. Over-leveraging is the engine of emotional catastrophe. It is the psychological barrier law. When you risk 5 or 10% on a single trade, every minor fluctuation in price becomes an intense personal threat. This creates intense emotional pressure, forcing you to make irrational decisions like moving your stop or exiting a profitable position prematurely. The 1% risk is designed to make the trade feel insignificant, allowing you to follow the plan without crippling fear. The crowd is obsessed with the myth of high reward to risk RR ratios. They chase setups promising a 5-to-1 or 10-to-1 payoff. But a 1-to-5 RR ratio is utterly useless if your trading strategy only wins 10% of the time. The focus must be on statistical viability and a tested edge, always operating within the safety net of the 1% rule. The ratio means nothing if the underlying method is not profitable over a statistically significant number of attempts. You must abide by the law of maximum stop distance. The market tells you where a proper stop must be placed, just beyond a clear support or resistance level. If the distance from your entry to that correct stop is so wide that risking 1% of your capital results in an absurdly small, inefficient position size, the setup is invalid. Do not widen your 1% risk. Simply discard the trade setup and wait for a more favorable geometry. The speculator must never, under any circumstance, risk their capital on hope. Once the trade moves against you and hits the predefined percentage that equals your 1% risk, you must cut the loss immediately. Hesitation is the first sign of a gambling mentality. Protecting the integrity of the 1% mandate is more important than being right about any single stock. I have watched countless accounts destroyed by men who violate the principle of doubling down after loss. They see a loss and believe the market is now due to go their way, so they increase their position size on the next trade. This mathematical rejection of the 1% rule is pure folly. It is the shortest, fastest path to the destruction of your entire trading capital. Every single trade must be treated as a fresh test of the edge, risking only 1% of the remaining capital. The market extracts a steep psychological toll. Therefore, implement the rule of consecutive losses. If you take 3 consecutive 1% losses, you must stop trading immediately for the rest of the day. This mandatory cooling-off period prevents the emotional spiral of revenge trading. 3 losses do not necessarily invalidate your system, but they certainly signal mental fatigue and the need for detachment. You must learn the fundamental difference between capital and cash. Your trading account is your fixed capital base, the engine of your enterprise. You must never violate this core capital base when calculating your 1% risk. Only withdraw the profits, the surplus cash generated by successful speculation. Preserving the principal is the highest function of the professional. The primary function of the 1% rule is to accept small losses swiftly. When you know the loss is negligible, only 1%, the psychological pain associated with exiting a bad trade vanishes. The crowd holds on to losers because the loss hurts too much. The master cuts the loss instantly because it is just a statistical tick in the journal. The necessity of a trading journal cannot be overstated. You must document every single trade, noting precisely the 1% calculated risk you took. The journal is where you quantify deviations and enforce absolute adherence to the rule. You must be able to prove on paper that you never violated your own foundational mandate. The trader's ego trap is the most common reason for capital destruction. The moment you feel invincible, after a successful run, you are most vulnerable. You disregard the 1% rule, deciding to make up for a previous small loss with a massive ego-driven position. This burst of arrogance guarantees your future failure. The market humbles every man who thinks he is smarter than the tape. You can only trade based on a defined edge. This is fundamental. The 1% rule provides the indispensable safety net for survival. The edge, your tested system of price action and volume analysis, provides the only opportunity for profit trading without a statistical tested edge is pure gambling, regardless of whether you risk 1% or 100%. The discipline protects the capital, but the edge creates the wealth. The profitable existence is systematic and often quite boring. You must embrace the boring. The constant, repetitive, and mundane application of the 1% risk rule is the hallmark of the professional excitement in the market is an expensive entertainment, reserved only for the 99% who ultimately lose everything. This leads to the paradox of small risk. By rigorously risking less on every transaction, you gain a massive psychological advantage, greater confidence. This confidence allows you to hold your winners longer, trust your system implicitly, and execute your mechanical trades flawlessly without emotional interference. Small risk creates big conviction. You must identify your trading archetype. Are you a disciplined, unemotional 1% risk manager who treats speculation as a business? Or are you an emotional, reckless gambler who risks capital based on feeling and hope? There is no middle ground. You must choose which path you walk and commit to changing your nature if necessary. Longevity in the market is the only true and honest measure of success. This is the ultimate law of survival. Wealth is accumulated over years, not weeks. Longevity is achieved solely and entirely through the absolute, unwavering, and strict limitation of your risk. Preserve your capital and the opportunities will always return. Successful trading is a professional endeavor that demands the highest level of personal discipline. This journey demands the permanent commitment to never violating the foundational principle of capital preservation. If these words hit you, it means you're not here by accident. Subscribe now, like this video, and leave a comment. That simple action helps more people find this content. And it tells me that my work still matters. But the battlefield of the market is the mind, not the chart. If you want to understand the true psychology of speculation, you must read the one book that defines the game I am talking about, Reminiscences of a Stock Operator. It is not historical. It is a permanent education in human nature and market cycles. The book is pure truth. Get your copy today. The link is in the description below.